Hello, in this problem, this is the solution of the problem 118 using T accounts. I want to quickly go through and show you how to do it using T accounts. First transaction says the, the owner opens a business bank account with a deposit of $36,000 in exchange for common stock. That's a debit of cash of $36,000 and credit to common stock of $36,000. Because they're increasing assets and that's debit, the cash is debited, and they're issuing equity, and the equity goes up, it's credited. Note here I have the trial balance right here, and it's in balance. Second entry, entry B, purchase office supplies on account $1,800. The office supplies is an asset that goes up $1,800. To purchase it on account, meaning they promise to pay later. That's an account payable. That's a credit of $1,800. Entry C, received cash from fees earned for managing rental property, $67.50. So they are receiving cash of $67.50, the payments basically from customers. That's a debit to cash. And they are generating fees. That's a revenue. That's a credit of $67.50. Entry D, paid rent on office and equipment for a month, $5,000. So they're crediting cash $5,000 because they're paying it. And they have rent expense of $5,000. They're debiting. Entry E, paid creditors on account $1,375. So they're paying cash, so that's a credit to cash of $1,375. And they're debiting accounts payable because there is no longer a liability of $1,375. Note that everything is still in balance on my trial balance because the left is equal to right. Entry F, billed customers for fees earned for management of the property, $9,500. So they're billing customers. That means they're getting a promise to pay. That's an asset called account receivable. Debit $9,500 because it goes up. When you bill customers for services rendered, that's revenue. Credit $9,500. Then we paid automobile expenses for a month $840 and miscellaneous expenses for we're paying miscellaneous expenses $960. Now we're paying them, that means there is a credit of $840 to cash and $960 to cash. But debit needs to be to automobile expense. In this case, it was $840, and to miscellaneous expense of $960. Paid office salaries $3,600. So when you pay salaries, that's a salaries expense. That's a period cost. You debit that in the amount of $3,600, and you credit cash because you paid it. Determined that the cost of supplies on hand was $350, and therefore the cost of supplies used was $1,450. So they used up the asset called office supplies. So you're spending it, so you credited $1,450, went up, and that's a supplies expense, right? Because it's a cost of doing business. So I have cost of supplies expense here. That's a debit. And finally, paid dividends. Now, dividends are paid out of retained earnings, so that the retained earnings go down. So you debit retained earnings $3,000, and you credit cash $3,000. And note that so far everything's been perfectly in balance. I have debits equal, I have assets, so here equals equity and liability accounts here. Now I put the expenses and revenues here as well, simply because I didn't want to. It's easier for me then later on to produce financial statements when I do closing. Now, so this is called kind of a trial balance. It's not exactly a trial balance because technically a trial balance would have all debits on one side, all credits on the other side. And here I recorded expenses as negative credit essentially, just for convenience. But that's fine. If you can see here, I already have the automatically produced financial statements. How did I get there? I have the income statement and the balance sheet and all of that. What did I do? Well, I closed, meaning what? I transferred all revenues and expense accounts to retained earnings. So we need to zero the revenue and expense accounts out, and the corresponding offset goes to retained earnings. So here, my total revenue for the year was 16,250. So to zero it out, I'm going to debit it, right? And I'll credit retained earnings for the difference. And I'll do so now. This is my only revenue accounts, my only revenue account. So I'll do the same thing with my expense accounts. So in this case, I'm crediting rent expense to close it, but it means that I'll have to debit retained earnings here. I'll credit my automobile expense 840. And I'll debit it here. I'll do the same thing with my miscellaneous expense, 60. And I'll do the same thing here. Salaries, 3,600. I'm going to credit them. I'm going to debit the to retained earnings. And finally, cost of supplies. Credit 1450. Debit retained earnings. Now, after all of that, you can see that all of my revenue and expense accounts are zero. They're temporary, so they're closed. And my final retained earnings balance should be all credits minus all debits, right? Because it's a credit account. It's $1,400. And that, in fact, is the credit of $1,400 what gets carried over to the balance sheet. And that's what I have here. Notice that in the final balance sheet, I no longer have, unlike on the trial balance, revenues and expenses. All I have is just payables, common stock, retained earnings, because all of those guys here were basically transferred over and netted against retained earnings. And that's how I get, that's basically what did the closing. So assets remain assets. Liabilities plus owner's equity, now there are no more revenues and expenses as I have on trial balance. And instead, all the revenues and expenses show up on the income statement account right here, right? It's just a listing of revenues and expenses. And my net income for the year was $4,400. And that concludes my discussion of problem 119. Thank you for listening.